thank everyone for coming. Some of you may have seen a version of this. Can you put on full screen? Is that, yeah, short. All right. Well, I don't know quite what happened, but thank you for inviting me. What I wanted to talk today was about something called long-run valuation risk and equity and asset prices. There's a basic fact. Okay, this is not working. All right. I want to start off talking about something called the correlation puzzle. Standard asset pricing models, going all the way back to Lucas's seminal contributions, emphasize that expected returns for holding an asset are a reward. They basically reflect the covariance between an asset's payoff and some agent stochastic discount factor. But it turns out there's a basic challenge that faces this model and basically most structural asset pricing models that have been developed in the last 30 years. And that is that the covariance and the correlation between stock returns and measurable fundamentals. What do I mean by that? The stuff that we put in our models as economists. Consumption, growth rate in particular, but also output growth rate is very weak. And it's not just weak at a 1 month horizon. It's weak at 1 month, 1 quarter, 1 year, 5 years, and even 10 years. That's a problem. Now you might say, well, correlations are way too simple. So I'm going to use some fancy time series methods. And, great example of that is Letow and Ludvigsen, 2011 paper, very nice paper, where they say, look, let's use time series methods to identify the shock that accounts for the vast majority of asset price fluctuations. And it turns out that shock is uncorrelated with consumption at virtually any horizon that you look at. That's a problem. Now, we're certainly not the first people to notice that. Lars Hansen and John Cochrane in the 90s and John Cochrane and John Campbell called that the consumption puzzle. And that simple weak correlation basically underlies virtually all modern asset pricing puzzles. Let me give you some examples. The equity premium puzzle, the Hansen-Singleton style rejections of asset pricing models, Shiller's excess volatility of stock prices, and just go on and on. What's the problem? Well, I'm going to take a particular tactic today, which is if you think about classic asset pricing models, all of the uncertainty is loaded onto the supply side of the economy. What do I mean by that? The stochastic process for the endowment in a Lucas style model, that's the only source of uncertainty. And if you go to production economies, by and large, people look at shocks to productivity, certainly an important source of fluctuations, but it's the only source of fluctuations in many, although not all models. What all those models do is they abstract from any notion of changes, or well, I should say shocks to the demand for assets. Right? There's no such a thing in a Lucas model. So once you think about all of the uncertainty being loaded onto one side, you ought not to be very surprised that you can't simultaneously account for the equity premium and the correlation puzzle. Whoa. Sorry. Okay, what's the other shock? How am I going to think about it? I want to consider the possibility that there's something like a shock to the demand for assets. Now the question is, how am I going to parsimoniously parameterize that in some way that imposes discipline on the process? Okay. What I'm going to explore today are demand shocks that arise from stochastic changes in the agent's rate of time preference. Mechanically, that's what I'm going to do. Now, in the macro literature, for example, the zero lower bound literature suggests that that's a very useful way to model changes in household savings behavior. But also in the real business cycle tradition, people like Victor Rios-Rull and co-authors have also considered this possibility. What do these shocks stand for? Well, I'm going to think of a low frequency interpretation. Later on, I'll come back to a higher frequency interpretation. Well, the simple fact is at a low frequency, we think there are changes in demographics of stock market participants. We think that there are institutional changes in the stock market. All of those things are going to change the, quote, demand for assets. I'm also going to take quite seriously that there are higher frequency changes, which we'll talk about later. Now, if I didn't have any discipline on this process, it'd be pretty boring, right? I'd get whatever I want. It turns out that in the theory I'll talk about today, these, quote, preference shocks map one-to-one directly into the level of the one period ahead risk-free rate. Okay, so anything, I must parameterize the law of motion for these discount rate shocks because they map one-to-one into the risk-free rate. Now, we don't have direct observations on the risk-free rate. We have some proxies of the sort that Prescott and Mayer and others used. We doubt that those are right on quarter to quarter, but we certainly want to match, the key characteristics of our proxy for the the literature takes to be the measure of the risk-free rate. Okay, so what's the actual model? Well, the model is going to be a kind of vanilla model. It's going to be a representative agent model with Epstein-Zinn preferences, and I'm going to land up estimating that data over a very long sample period, for example, 29 to 2011. And I'm going to argue that the model easily accounts for sort of the standard kind of asset pricing moments that people look at. Equity premium, volatility of stocks and bond returns, etc. So it's going to get that easily. But then I'm going to ask it, can it measure this correlation between stock returns and, quote, consumption growth rate, dividends, things of that nature over short, medium, and long horizons. I'm going to use the model to argue that we've been, at least the standard literature, we can decompose asset returns into two components. There's going to be what I'm going to call valuation risk. What's valuation risk? It's the risk associated with the way, valuation risk are the risk associated with changes in the way that future cash flows are discounted. So if you sort of listen to the way people talk in the market in the real world, they go, well, long bonds are risky because if cash flows change, the interest rate changes, how they discount them, that's really going to move asset prices. That doesn't make a whole lot of sense in the standard model. Now, it turns out in the model I'm setting up, that has a meaning, and it entirely has to do with changes in those preference shocks that map into the one period ahead risk-free rate. And in fact, for the finance experts in the crowd, you can think of this as a GE version of Vlasic, who had the classic statement about the short-term interest rate. Now that changes into changes in valuations. This is a GE version of that. He didn't say where that interest rate, why that interest rate varied. Now, it turns out valuation risk in the model is much, much more important than covariance risk. Basically, covariance risk is rounding error. Now, it turns out there's a natural test of this theory. Not surprisingly, and I'll formalize this later, valuation risk depends very much, it's an increasing function of the maturity, of the duration of an asset, right? So intuitively, stocks are an infinitely lived asset. 30-year bonds or 20-year bonds are very long-lived assets, very different than, say, a one-year bond. And our theory basically says the longer lived this object is, whatever asset is, you're going to be more exposed to valuation risk. So you might say, well, okay, fine. There's a natural test of your model. Does it explain the premium between stocks and different kind of bonds? And in fact, does it explain the premium between bonds at different horizons? So I'm going to show you some evidence on that, and the answer is yeah. What we haven't done is any cross-sectional stuff where you somehow characterize portfolios of individual stocks as representing longer or shorter lived duration type portfolios. We haven't done that yet. I mean, that's an obvious next step. Okay. I'm not going to talk a lot about data because it's all kind of standard stuff. I do want to emphasize that we're going to be able to use Barrow and Ursua's data for consumption expenditures and real per capita GDP, going back to 1929. And then we're actually going to use a wonderful data set by Nakamura, Steinson, Barrow, and Ursua that goes all the way back to 1870 all the way to 2006. So we're looking at very, very long time series here. But I want to start with some basic facts to convince you that there's a puzzle here. So I want to look at some data between 29 and 2011 and ask, gee, what's the correlation between one-year stock returns and consumption growth? Well, it's zero, roughly speaking. There's nothing there. What's the correlation between at a 5-year horizon? It's zero. What's the correlation at 10 years? Well, it's actually negative. Well, you might say consumption's kind of a poetry for output. Output, 0 at the 1 year, 0 at the 5 year, 0 at the 10 year. There's nothing dead. There's nothing there. Now, and this is important to my story, dividends are kind of different. There's like a slope here. There's nothing at the 1 year, but there's definitely something at the 5 year, and that's going to be a challenge, and there's definitely something at the 10 year. And interestingly, earnings, right, have a similar pattern to dividends. But there's going to be an interesting tension. Can I get this and the dividend thing? That's going to be not so easy. Now, what if you go back to a longer time series, 1871 to 2006, same story. Consumption, 1 year, nothing. 5 years, well, there's a little something, standard error is kind of marginally significant. 10 years, you're back at nothing. Output, nothing, something there, 5 years, then it goes away. At 10 years, it's zero. Dividends, again, that similar pattern. It's much, you do get this correlation stronger at as you go up in time. So that's kind of interesting. Now, you might look at the NIPA measures, right? This is quarterly. I'm not going to be working with quarterly data, but the other data is not NIPA, so you want to look at this. And, well, I should say it doesn't break it down to non-durable services and durables. But again, if you look at durables and stock returns, nothing, nothing, nothing. Non-durables, nothing, nothing, nothing. There's kind of a little more there for services, but then nothing, nothing. So I look at all of this and I go, there's nothing. But this is at the core of our models that we teach. Now, if you're a finance guy, you might say, look, I don't care much about correlations. What I really care about is covariance, right? The problem with covariance is very hard to come up with a natural unit. So Jonathan Parker did a very clever thing. He just estimates the covariance between consumption growth and stock returns in the quarterly data in the post-war. And he says, how big a risk aversion coefficient do I need to get the equity premium? And he needs 379. You know, if you really believe that, he would have never gotten out of bed to write the paper. Now, he actually did something that's kind of interesting. He said, I don't want to take the theory that literally, so let me look at the the covariance between current stock returns and the cumulative consumption growth over the next 12 quarters. By the way, theory doesn't suggest you do that. So, but I think it's an interesting exercise. And there's more of a covariance there. But even at that level, you'd still need a risk aversion coefficient of 38. Right? So doing things in lots of different ways, it's very hard to see how at least the standard models are consistent with this. It's not just Lucas. Lucas, of course, is the canon, so that's my axiom. But if you have Lucas-style constant relative risk aversion or Epstein-Zinn, there's nothing special about Epstein-Zinn here. All of the uncertainty is on the supply side, so when I do that model, it's going to have a huge problem. It doesn't do any better. If you do habit formation, either internal or external, in principle you might say, gee, well, you know, it's a nonlinear model, and so I could mute that correlation at various horizons, right? But if you look at 1, 5, and 10, you're just not going to get much out of that. So that's going to die. Long-run risk models, which are very interesting models, and I'll come back to talk about that today. Long-run risk models have short-run risk too. That gives you the classic correlation problem. If the long-run risk is realized, that's going to just make it even stronger, right? Because the tree is going to die, stock returns are going to go down, so that's double whammy. So that's not going to solve it. Rare disaster models, of course, it's exactly the same as the long-run risk model, so that's not going to help. Where you might get some stuff is if you had time-varying long-run risk model. If agents got signals about the probability that the tree might die in the future, then stock returns would go down, but consumption wouldn't. So that would help. So maybe in a short sample, you might be able to rationalize things. So you can't rule that out on logical grounds. The only thing I would say there is if you go to 1870 to 2006, that short sample argument isn't helping you. So it's possible, and you know, it's great for people to think about that. That's not what I'm going to pursue. Okay? Here's what I am going to pursue. I'm going to look at Epstein-Zinn, and for most, whenever I do Epstein-Zinn, I get scared because it's kind of creepy and weird, so I have to go very slowly with Epstein's in. So here's what Epstein's in is, and I'm going to do it slowly just to keep my head in it, all right? So here's your utility today. There's two components here. There's the current, some flow from current consumption. I'm ignoring that for just right now. And then there's this, people care about a certainty equivalent to future utility, U star. Okay, we put those two together. This C, that parameter C, governs the intertemporal elasticity of substitution. So if C was infinity, so it's really big, folks don't care about substituting between the current consumption-based flow and that certainty equivalent in the future. So that's standard Epstein's in. What I've done here is put in a lambda t. Now, what's that lambda t? Well, the ratio between lambda t plus 1 over lambda t determines how agents view the trade-off between their current utility flow and that future utility. Now, by the way, you could ask, I could have made delta of t rather than lambda t. That's going to be isomorphic. The other question you might worry about is, are these time-consistent preferences? And we woke up in the middle of the night about 4 months ago in a panic about that, and yeah, you can prove they're time-consistent. You've got enough recursivity in this setup that time consistency of agents' plans is not an issue. Okay? So let me just go over what U star is, because that too freaks me out. What is the certainty equivalent? Well, Epstein and Zinn, and I guess the other guys, this first line just repeats what the utility function is, right? So the current consumption-based flow and the future stuff. What is U star? What's the certainty equivalent? Well, it's defined to be this number to the 1 minus gamma is exactly equal to ET, the conditional expectation of UT plus 1 to the 1 minus gamma. So you solve for U star T, and you get this ugly looking object. And gamma is risk aversion. So we have these two parameters. One is the intertemporal elasticity of substitution is governing the current consumption-based flows. And then we've got this certainty equivalent and risk aversion on the current consumption. Okay, first case you might say is, gee, what if I just looked at constant relative risk aversion? Would I get anything out of this? Well, this is key. If the risk aversion coefficient, right, is just equal to the inverse of the elasticity of intertemporal substitution, the mess that I just showed you just reduces to a good old-fashioned constant relative risk aversion, except the discount rate is not delta to the I, it's got this weird lambda in there. That's a stochastic process. And interestingly, this was actually a case considered by Garber and King in a very early famous paper in the early 80s, because when you have a stochastic discount factor, GMM, at least as a la Hansen-Singleton, won't fly, because you have a nonlinear function of an unobservable, and you can't derive unconditional moments. So they talked about that. And then John Campbell considered this case in a QJE paper in the 80s, and he said, I'm not getting much out of this. And he was right. I'll show you that with constant relative risk aversion, these discount shocks do nothing whatsoever. It's critical that you interact them with Epstein's in. Okay, so that's to be shown. Okay, so I'm going to think about an endowment economy. And if you've been following the finance literature, people do pretty fancy things. I don't want to do fancy things. I want to make this as simple as possible. So what I'm going to have is the tree is a martingale, and the shock to the tree is not conditionally heteroscedastic or anything like that. It's conditionally and unconditionally homoscedastic. So that's about as vanilla as you're going to get. And I'm going to take seriously normality for today. I'm going to distinguish between dividends and consumption the way the modern asset pricing literature does, where people think of the stock market as dividends is what we're pricing in the stock market ultimately, and that is correlated with consumption, but it's not identical. So how do they capture that? Well, again, they say dividends are a martingale. There's a shock to the dividend process, and then there's another relationship between the shock to the tree and the shock to the dividend process, that pi dc. So with these assumptions, the log of the dividend consumption ratio follows a random walk with no drift, and that's a pretty good model of those objects. Okay? Now we get to the hard part. I'm going to talk about the time preference shock. Remember, what's important here is the ratio of lambda t plus 1 to lambda t. I'm going to assume that's an AR1. Now remember, I can't just assume anything I want, because in the end I'm going to show you this maps into the risk-free rate. But I'm going to assume that's an AR1. And the other thing is, from an information point of view, important, at time t, agents know what lambda t plus 1 is. Right? So that's an information-based assumption. So they know how they're discounting today versus tomorrow at time t. And this will be my initial stab, but I'm going to complicate this a little bit later for reasons I'll motivate with the data. But I want that to be the benchmark case. Okay, this is an endowment economy. So what's the natural assumption for an endowment economy? Well, the tree is the tree. God decides how many apples there's going to be, and he doesn't care about your preference shock. So that's a benchmark case in which we assume that all these shocks, the preference shock is uncorrelated with the tree. But as someone who likes to build models that are useful for other purposes, I know in a real business cycle model that certainly wouldn't be true as soon as you go to a production economy. Right? If people's attitudes towards changing changes, how much they work changes. And how much work changes translates into how much output there is in the tree. So putting this into a full-scale production economy is way beyond what we can do today, but it is really important. The long-term project here is to say we can't ignore the failures of the classic real business cycle theory for asset pricing or DSGE models of the sort that Larry Cristiano and I work with. Because at the guts of both of those models, and certainly in the NK model, is this Euler equation that doesn't fit. You kind of hope that it's getting the main mechanism, but if you confront it with asset pricing data, forget all that other junk about Calvo, etc. There's that lonely little Euler equation sitting out there naked, waiting to be rejected. So you better fix that. So that's phase 2 of the project. Okay, CRRA case. What is CRRA? Just suppose that risk aversion is equal to 1 over the elasticity of intertemporal substitution. Then with lots of algebra that's in the paper that I won't bore you with, what's the unconditional risk equity premium? RC is the rate of return. This is for the special case when price, say stocks correspond to the tree. The algebra is pretty. Then this would be the rate of return on the stock market minus the rate of return on the risk-free rate. This is kind of fun. This is the standard thing that we teach students, right? When things are normally distributed, the equity premium depends positively on the risk aversion coefficient times the volatility of the innovation to the tree. We all know in the data, sigma squared c is really tiny, and you need nutty gammas, which would screw you up in other ways. So this doesn't, we know we're not going to get much out of that. The only thing, or the key thing that preference shocks do with CRRA is they affect the unconditional risk-free rate. But if that's how I'm going to explain the equity premium, that's crazy because the risk-free rate's small in the data. So the only way I could get the equity premium big in this model is by having nutty implications for the risk-free rate. So the fact that these preference shocks are so closely identified with the risk-free rate tells me this is not the way to go. That's not going to fly. Okay, so it's not surprising that John Campbell couldn't get much out of this in the 80s when he tried to do it. Okay, I'm not going to do a lot about solving the model because it's late, people are tired, and I better show you some payoff or all we're going to be out of here. As I said, I'm going to define stock market returns the way they do in the finance literature. It's the dividends that we're equating with the stocks. So RD T plus 1 is the 1 period ahead rate of return on the stock market. It's the dividends at T plus 1 plus the price at T plus 1 divided by the price. In all of the future notation, a little R sub D is just the log of the price of the return. In some examples, I'll use the rate of return on the tree, which we don't actually see, right? But it's still fun to look at in the model. That's going to be defined exactly analogously. All right, so a couple statements about the stochastic discount factor here. So this is the true test of when you're teaching, right? Do you actually derive the log SDF in the Epstein-Zinn case? Because that's a whole separate field, right? There's Calvo algebra, there's Epstein-Zinn algebra. And if you ever want to convince someone who's not religious that there is a God, have them work through this derivation. And when they get to the end, they're going to believe in God. It's quite stunning that it comes out so nicely. What I want you to see for right now is this is pretty familiar. Here's the SDF, and this is sort of the standard discount rate. Here's my new friend. There's this theta, which is going to be critical. It's going to be 1 minus gamma over 1 over 1 minus xi. So the constant relative risk aversion case, this is 0, and this is 1. But if theta is equal to 1, then the rate of return on the consumption tree disappears from the SDF, so that goes away. And then this just turns out to be, the growth rate of consumption times the risk aversion coefficient, which is equal to 1 over the elasticity of substitution. The more general case is this one. Okay, so how do you solve a model like this? Well, you could either get on the computer and get an exact solution, or you can be very clever and exploit Campbell-Schiller, which is basically what you do is you use a Taylor series approximation of the unconditional rates of return, method of undetermined coefficients, and you take log normality seriously. And that's what I'm going to do today. The nice thing about that is it's really easy. There's a bunch of algebra, but you don't need the computer particularly, and it's really nice. What are the returns to equity in this kind of a world? Well, here's the expected return to equity, to dividends, and it's kind of ugly, but stare carefully and you'll see some interesting stuff here. First of all, it's pretty log of lambda t plus 1 over lambda t. If agents really value the future more, they really want to save more, but they can't save more in the aggregate, so the return on equity has to fall. So that's easy. The other thing that's interesting about this relatively ugly expression is this is a constant. This part here is, the time varying component because of the preference shock. This is the volatility in the tree. That's both sigma squared c and sigma squared d, right? They're both basically coming from the tree. And then there's a part that comes from the volatility of the preference shock. So naturally, you can imagine I can ask how big is this junk and how big is that stuff? That's sort of the interesting question. Lucas and the rest of the literature focus on this stuff. That's what we've all been focusing on, and we'll see that that's not very important. So this is just saying what I said. So I'm going to call the compensation that an agent gets, the return that's due to sigma squared lambda, the volatility of the preference shock, that's what I'm calling valuation risk. All the other stuff, the covariance stuff, is the conventional risk. I'll call it that. Suppose I just look at stock market. I just say the stock market coincides with the tree to get intuition. Then what's true then? The rate of return, what is valuation risk there? So if you go back 2 slides and make everything simple, the part that's due to the volatility and preference shocks, well, that's positive. That's positive. Well, then the question is, does valuation risk help me or hurt me? It depends. If theta is negative, I'm okay. If theta is negative, then that's positive, and I get stuff for the equity premium, or equity and returns. But notice there's 2 ways that this can be negative. One is agents are really risk averse. Gamma's bigger than 1, more than log, so they really are risk averse. But they don't mind intertemporally substituting a lot. So the inverse of their EIS is less than 1. That's one thing. But intriguingly, these guys might not really care. They may not be really risk averse. Gamma just, this could be between log and 1. But if they really don't like intertemporally substituting over time, this guy's going to kick in big. So again, this theta is everything in this model. What about the risk-free rate? That's important. It's not much of a victory to get an equity premium if you screw up on the risk-free rate. So here's what the risk-free rate is. Again, if agents want to save a lot because their discount rate went up, right? The risk-free rate has to go down to discourage them from doing that. There's a bunch of stuff. It is definitely affected by the volatility of the preference shock. So if that thing's really big, I could get crazy implications for the risk-free rate. So I better check the data. And this is the familiar part having to do with the volatility of the tree. So we have here and here is where the risk-free rate is being affected directly by the preference shock. And you can already see over here, what's time varying over here? Well, the risk-free rate, the only thing pushing it around is the preference shock. So in principle, this maps 1-to-1 into the preference shock and a constant. So any time series properties of the preference shock better be shared by the risk-free rate, or I'm cheating. So that just says I can measure movements in lambda t plus 1 over lambda t by looking at the risk-free rate. What's the equity premium? Well, you do a bunch of stuff here, but what you want to notice here is the equity premium from this whole expression. For time preference shocks to help, this theta better be less than 1. Remember, theta is everything in this model. Okay, I may not be able to estimate risk aversion or the EIS with a lot of precision, but theta is crucial, and there's, I better get that one. In fact, if I only think about stocks as a claim on the tree, I just need theta to be less than a half. Things get much simpler, and you can do the algebra. There's not much intuition for that half versus 1, but that's true. All of these conditions or theta are always going to be satisfied in the empirical work, but of course they have to be, because I'm going to measure theta to make sure that I fit the data. So this is some weird stuff. I mean, this is how different this theory is than the standard thing. Suppose there's no risk at all with the assets. God likes you. It's a constant tree. It's always, you're going to get, it's a totally deterministic process. Will there be an equity premium? Well, in standard models, of course, the equity premium is 0. There's no risk. There's no covariance. But I'm still going to get a positive equity premium. Why is that? A 1 period ahead bond, there's no valuation risk, because remember I told you a T agents no lambda T plus 1. So 1 period bond is cool. But what about stocks? They're an infinite duration asset. So I'm really worried about, when I get there, my attitudes may be that I really don't particularly like that stuff. The discount rate has really changed. So in this kind of a world, the longer the maturity of an asset, the more exposed you are to a change in this discount rate, if you like the risk-free rate, and that's going to have a longer and bigger effect on the value of the price, on the price of the asset. So duration here is critical, unlike a standard model where duration really is kind of boring and uninteresting. So this is the kind of model that will map into rhetoric where people say the 30-year bond is really exposed to movements in the short rate. That doesn't have a whole lot of meaning in a standard model. Let's make it even weirder. Suppose that there are supply shocks to the model, supply shocks, but agents are risk neutral. Suppose they're just risk neutral. Standard model, what's the equity premium? It's 0. But remember, I had 2 branches for when valuation risk matters. It could be that agents really hate to intertemporally substitute utility flows. So even though they're risk neutral, they know they're these crazy lambdas, I got to pay them for exposing themselves to that risk. So even in a risk neutral world, we're going to get an equity premium, and duration, again, is going to be the key determinant of differential interest returns on assets. Okay, what's the relation to long-run risk models? Because those are very interesting models, and I think it's interesting. I'm not dumping on them at all. I think they're interesting. If you look at our model, and instead of where I had CT here, you put C twiddle T. Let's make up a new symbol. I had lambda T, CT to the blah, blah, blah. Just call it C twiddle T. C twiddle T is just lambda T times CT. Take logs. So you have log C twiddle T, depends on the log of lambda T, and the log of CT. I've just repeated that over there. What do Banzal and Yaron do? What they say is I'm going to introduce a highly persistent component in the log of CT, and in their world, what is that? It's long-run risk. So they're going to introduce it into CT. What did we do? Well, I basically did that to log lambda T, to the preference shock. So there's clearly a relationship. But are these models observationally equivalent? Of course not, because I get to see CT. So for example, if I exploit the correlation between stock returns and consumption, Their model is going to have one set of implications, which is very different than ours. If I exploit the implications of their model for bond returns, what's true about, and I'll come back to this later, in a long-run risk world, bonds are fantastic. The tree may die, right? The plane may hit the tree and kill the damn thing. But I got a bond, so I'm eating that day. So I'm going to pay a huge amount for that insurance. And long-term bonds have negative rates of return in a Banzal-Yaron world. And in fact, the whole slope of the term structure is going to be, downward sloping because you're willing to pay more insurance the longer the bond is. Our model is not going to have that implication at all. We're going to have a positive rate of return on bonds, and we're going to have an upward sloping term structure of bond returns. So that's the consumption stuff and the bonds sharply distinguishes between those models. Okay, so what do we do? Well, what I always do, I'm going to use GMM to estimate stuff. So how am I going to proceed? So let me just define some notation here. What's psi-d? That's a big vector of moments of the data that I'm interested in. And every time I give the talk, people want me to add moments, and that's fine. By the way, in principle, you could do just estimate maximum likelihood here, right? But there's a lot of assets, so we're starting off this way. Because I got log normality, I can do whatever I want. But we're doing GMM today. So I have a bunch of moments that I'm going to estimate, and then for any set of values of the model parameters, I can deduce the implications of the model for those moments. And that's not entirely trivial here because I only want to work with annual data because I think the higher frequency stuff is very bad. So I'm going to assume agents make decisions at a monthly frequency and deduce the implications for average annual data. So there's a little temporal aggregation thing going on here too. And then I got a quadratic form. What's this psi-d? It's the standard covariance matrix, of the moments that I estimated. And I'm going to estimate that, and I'm going to use a Newey West estimator, blah, blah, blah. Okay, so that's all standard. So that's pretty standard. These are the moments that I'm going to look at, and as I said, I'm going to add some in just a few moments. So what you're going to look at consumption growth, the mean and standard deviation, dividend growth, mean and standard deviation, the correlation between one-year growth rate of dividends and the one-year growth rate of consumption. That seems reasonable. Real stock returns, mean and standard deviation, real risk-free rate, importantly, mean, standard deviation, and this serial correlation, which is going to come back to haunt me in about 2 minutes. The correlation between stocks and consumption growth at 1, 5, and 10 years, and the same thing for stock returns and dividend growth. Now, when you solve this model, you need the growth rate of consumption dividends to be the same, the unconditional growth rate. So we impose that. That doesn't look so good actually in the data, so when I do the just raw data moments, I'll show you those estimates as well so that you can be convinced that I'm not doing something totally crazy. So I've already said this. This is important. I'm going to use realized stock returns, so that's okay. But what about the risk-free rate? Well, what Ed did with Raj Mehra is they looked at realized real returns on nominal one-year treasury bills, and they subtracted inflation. And I'm going to continue doing what those guys did. As you go out, this gets harder and harder. We don't have tips for a very long time period, so we don't have good data on the risk-free rate. You could imagine pricing nominal returns and then having a forecast model of inflation, but anybody who's tried to forecast inflation for 5, 10, that's kind of hard. So I don't think there's a perfect solution to this. I'm open to both ways of doing it. Today what we do is just use ex post real returns on treasury bills. So that's what we're doing. But I could imagine alternatives. So here are the parameter estimates for the benchmark model. And what you're going to get here is, this is kind of nice. You basically have log in terms of risk aversion. The intertemporal elasticity of substitution says, it's a little over 1. They're a little hesitant to do it. Notice the standard errors here kind of look pretty big. Okay, but that you shouldn't infer from that you can set this equal to that. Because I already showed you that you're never going to get the equity premium. There's obvious covariance between those terms. What's the theta implied by this gamma and that psi? Well, it's minus 2.56. So it's pretty negative. I want to point that out. come back to that in a minute. And the row, I'll come back to, that's how serially correlated that's the AR coefficient. In the preference shock, that's going to be too big. I'm going to have to bring that down. But for the simple benchmark case, it's instructive to keep it simple. Here's some moments implied by the model. Look at the equity premium. In the data for this sample, it's 7 percentage points, or 6.13, depending on how you treat that dividends and consumption growth constant. It's big. Usually in these models, we're killing ourselves to get 20 basis points, 50 basis points. At the point estimates here, I'm getting 5.5 percentage points equity premium, which is well within the sampling uncertainty. So there's just, the equity premium is just, it's a non-issue in this model. What about the other things? Well, it's really important to look at volatility of the risk-free rate and also equity returns. You look at the risk-free rate habit formation models, they'll get you an equity premium, but if Cristiano Boldrini, Cristiano and Fisher have a lovely paper in the AR, they have habit formation, and if you look at what's the volatility of the risk-free rate in that model, it's more volatile than equity returns because you're really close, the habit's kicking, so any little change around there really is making the risk-free rate crazy. So that's a real weakness of the habit formation models because it's kind of crazy to say that the risk-free rate is more volatile than equity premiums, than the equity premium. So, but we don't have any problem with that at all. That's just fine for us. What about the correlation between the risk-free rate and stock returns? It's just fine. This is not fine. This is the AR1 coefficient on the risk-free rate. 0.61, which is what's in the data roughly, is much smaller than what our model implies. So I'm going to have to fix that, which I will. Okay, it turns out this isn't very hard to fix. At those point estimates, if you ask what's important and what's not important for returns, well, again, it's all about duration, and the more persistent that preference shock is, the more exposed agents are to duration risk. So I have an interesting test here. I got to bring that down because there's too much of it going on in the benchmark model. But basically, covariance risk is nothing. It's rounding error in this model. That's not what agents care about. And you see that in the traditional calculations where you kill yourself for 50 basis points, even pushing the gammas. Here are the correlations. Remember how I started this off. I said there's no correlation between consumption growth and stock returns in the data. What does the model say? Well, the model says, yeah, there's nothing there. Don't worry about it. Why? Because I have supply side shocks and I got demand side shocks and they're canceling out. I'm getting a cloud. No problem. Dividends are a little trickier. Remember, this is a model in which preference shocks are, that ratio was almost a martingale. And the tree is also martingale. So if you look at dividends, it's very hard to get anything but a flat structure for those correlations. That was true for consumption too. But with dividends, remember I told you that in the data it's going up over time, that correlation structure. So at 5 years, 10 years, dividends show more of a correlation. So this little model has to choose. It can either choose the short end or it can choose the high end. You look at the standard errors relative to point estimates, it's pretty obvious what it's going to have to do. It's going for the long end. Okay? If you just took this model, Epstein-Zinn, but didn't have any preference shocks, the correlation between stock returns and dividend growth would be 1, not surprising, and the correlation between consumption and stock returns would be 0.42. Why is this lower than that? Because remember, you're pricing the market, which is correlated with consumption, but it's not the same as consumption. So that's why that's a 0.42 and that's a 1. Okay, that's a sort of a standard finance trick. Okay. So there's 2 shortcomings, at least, to this model. One is the persistence of the risk-free rate, which I got to take seriously, but I'm going to fix that pretty easily. And the other is the absence of a correlation between preference shocks and consumption. So I want to fix both of those and see what that does. So how do I fix, I'm just going to go to this because of time. How am I going to fix the preference shock process? so that I bring down the correlation. Well, remember what I had initially was lambda t plus 1 over lambda t was an AR1. So that was sort of classic long-run risk. Now, I'm going to just sprinkle on some IID noise. And if you have a mixture of an AR1 and noise, guess what? The AR coefficient of the univariate process comes down. So that's easy. How do I interpret this? Well, I actually love the poetry, although I can't map it yet into... I love the notion that there are low-frequency changes in attitudes towards risk, and sometimes people freak out. They change in their attitudes towards saving. They just do. I find that totally plausible. I think that's what Woodford's all about, and that's been really useful. That's what Rios rule is all about. How important those two components are, well, I'm going to let the risk-free rate pin that down for me. But that's mechanically what I'm going to do, is I'm going to add this as a parameter, and I'm going to add the AR1 in the risk-free rate to the GMM procedure, and that'll pin that down. Now the question is, will the equity premium survive? Because if I make this 2 IID-ish, the equity premium is going to go away. The production economy is a little more complicated. Here, I just want to allow for the possibility so that when I go to the next stage, whether it's an RBC model or in a New Keynesian model, what does the data want to tell me about the correlation between those innovations? And will it overturn any nice results that I have now? So here's what I'm going to do. The preference shock I've already told you about. All I did was sprinkle on some IID noise there. But then when I get to the tree, the old specification was martingale and a little shock to the tree. Now I'm going to say that the tree is correlated with epsilon t plus 2. Why epsilon t plus 2? Well, I have that timing change at t, agents know t plus 1 as far as the preference shock goes. So the right thing to put is t plus 2. And then the dividend process, I'm going to do exactly the same thing. Interestingly, it turns out pi c lambda is going to basically be 0. But this thing's not going to be 0. This is going to survive. So that's an interesting question about how to input that to a DSGE model or a GE model. So mechanically, this is all quite easy. You add sigma n, what's that? The IID part of the shock to lambda t plus 1. Add that to the vector of objects to be estimated. And add the AR1 coefficient of the risk-free rate as one of the data moments. Now, if I just do that, the structural parameters are all going to be the same. Basically, it doesn't affect things much. Once you take sampling uncertainty account, I'm going to nail the risk-free rate and the equity premium that comes out of it. But the rho is still going to be big enough that I can get the equity premium within sampling uncertainty. So I'll show you guys that in a minute. Interestingly now, we're on the other side. Gamma, these agents are between log and 1 now. Standard errors are going to go up because I've added some free parameters. So gamma agents are less than log risk averse. But to compensate, the data is going to say they really hate intertemporally substituting over time because we get to 0.92. It's on the other side of 1. But don't infer from that these are identical. They're not because I have a very strong covariance term. What's crucial is gamma versus 1 over xi. The theta so this is the benchmark model. We had an equity premium of 5.47 and the theta was minus 2.56. Now, in what I'm calling the quasi-production model, the equity premium is 3.7, which is still huge compared to normal models. That's within standard errors. And the theta, of course, comes down to minus 0.79. Everything else is fine. I don't want to waste your time on that. This is the AR1 for the risk-free rate. The correlations, notice now you still nail the consumption correlation. And interestingly now on the dividends, remember before the model wanted to match the high end? Now it says, oh, I have a little extra degree of freedom there with that pi d lambda. That's just enough to say, you know what? I can nail pretty much within sampling uncertainty. I do pretty well if I now match the short end of that correlation rather than the long end. And this correlation puzzle is really important. Okay, you might ask, what if I tell the computer, thou shalt match the equity premium? Where is this model going to screw up? Because the equity premium did come down a little bit. I can tell the computer, you have to match the equity premium, right? That's no problem. If you do that, notice theta goes to minus 6.65. So that's what you need if you literally want to get the point estimate of the equity premium. And those are the gammas and the psi's that will do it for you. They're not very, it's basically log and close to EIS of 1. The difference is, you're still going to get the consumption correlations. Where you're going to screw up huge amount is on the consumption with dividends. If you insist on exactly getting the equity premium, you get killed on the dividends. And the GMM procedure looks at the standard errors and says, look, the equity premium is estimated with a lot of volatility. I don't mind sacrificing a little bit on that. I want to make sure I get these correlations because they're estimated with a lot more precision. I must be running out of time. Okay, how much? 5 minutes, okay, good. I want to say one thing here. If you calculate the correlations of Banzal-Kiku-Yaron for consumption, they're about 0.9. So that's one way to see. Remember, we got 0, they're getting about 0.9, 0.8, something like that. And the logic's clear, right? It's all coming from the supply side. What about bonds, which typically don't get as much attention as maybe they should? Partly for the data reasons that we don't have good, really great measures of the risk-free rate. As I told you, in a Banzal-Kiku-Yaron world, bonds give you a negative rate of return. So if you literally take the BKY model, which is a lovely model, at their point estimates, the 10-year yield is negative 0.43%, and the yield on a 20-year bond is negative 0.88. So notice it's a downward sloping thing. Rare disaster models, the standard ones, give you exactly the same thing. They're going to tell you bonds yield negative rates of return, and the longer out you go, the more negative they are. So what does our model tell you? Jesus, whoops. Let me just say, there's going to be uncertainty about how you measure these things. So first of all, I'm going to show you statistics for yields on a 1-month bond, ex post real, 5-year bonds, ex post real, and 20-year. And they're going to be consistent with Alvarez and Yerman's Econometrica paper that claims that the term structure is upward sloping. And at least until recently, TIPS, of course, now have a negative yield. But up to 2005, Campbell, Schiller, and co-authors said the real yield on bonds before the crisis was about 2%. What are we seeing in the data? A long-term bond, ex post, real, nothing fancy, just an average, 1.66%. Intermediate bond, by that I mean 5 years, 1%. 1-year bond, 0.36. Just ignore that for a moment. There's noise in how you measure these things. Our model tells you, these are the numbers for the model, and within standard errors, notice how we're just flipping. The short-term bond is not very risky at all. So it actually has a negative yield, which we saw for long periods of time. But if you look at the standard errors, we're fine, right? So our point estimates are easily fall within classic confidence intervals of these objects here. The next thing you want to ask is, wait, stop getting so fancy. What about long-term bonds versus stocks? Long-term bonds are 20-year objects. Long-term bonds in our measure are 20-year objects, but stocks are infinite. What's true in the data? What's the premium on stocks versus a long-term yield? In the data, it's 4.5%. With a standard of 1.84. Our quasi-production model says it's 3 percentage points. No problem. 20 years is not the same as infinity. It's very different. There's a slide here. There's some really cool stuff by Joel van Binbergen and co-authors who decompose yields on stocks. And they argue that most of the yield, I think it's 80%, comes after 5 or 10 years. So 20 is not the same as infinity, certainly not from the perspective of this model. Okay? So that's the Binsbergen thing. So let me conclude and then just stop because I know it's late. So this is a very different model than the kind of model I was used to growing up, in which returns reflect covariance. We've had a tough time as a profession with those covariance models. In fact, John Cochran has done wonderful work, talks about risk premia as explaining stuff. Well, if you look carefully, what risk premia is in finance, it's the error term. It's the junk you can't explain, we call risk premium, but it's very hard relating that risk premium to an observable. So we're just saying, what we're saying here is that movements in agents' preferences that are consistent with the model's implications for the risk-free rate easily get you the equity premium and transfer our way of thinking about asset prices rather than as big premium for covariance, but as premium for duration, which is a much older tradition in finance. And, you know, evidently, from the perspective of these statistics, there's some reason to favor that interpretation of the data. The next step is to see whether we can put this in, whether it's a real Arrow-Debreu RBC model, and what that does. But with Epstein's-in preferences, there's some hope that you won't have to encounter the problems that Baldrine, Cristiano, and Fisher did. In those models with high risk aversion that are bundled with intertemporal elasticity, the model really wants to smooth out consumption. But if it really smooths out consumption, you don't get any interesting asset pricing movements. Because we're explaining asset prices with, you know, intertemporal elasticity's substitution of 1, we're not going to face quite the same difficulty that they did. Whether that's enough, we'll see. So that's kind of the next step. So I'll stop there.
So we have time for a couple of questions. Just raise your hand, whoever wants.
So in your model, when you added eta, so you have the risk-free rate then is like an ARMA 1-1, yes, right, with a neg. So I guess 2 questions. If you look at the risk-free rate, the measure that you're using, do you see that? Because you didn't have that MA coefficient in your moment condition. And number 2, you know, some of that may be the, you know, because you subtracted, because it's an ex post interest rate, not a ex ante interest rate. So a lot of that eta could, in principle, be just the noise from pi t minus pi te or something.
It absolutely could be. So I think the longer you go out in the term structure of bonds, the bigger that inflation issue becomes. These happen to be 1-year guys, and it fits quite well. But I completely am sympathetic that once you go out to 5 or 10 or 20 years, the difficulty of measuring the risk-free rate is just really hard. I just, you know, eventually with the TIPS data, we'll have enough of it. Although even there, you know, there are no liquidity issues here, and a lot of people believe a lot of the movements in the TIPS, certainly during the crisis, were liquidity. So I'm totally sympathetic to potential problems of measurement with the risk-free rate. And we'll just try to do the best we can with different data.
Yeah, so I've been doing some work with Amir Yaron and one of our graduate students, basically embedding the long-run risk model into a state space framework and then estimating it. And one of the things that happens then is that, you know, you can introduce stochastic volatility here and there, and you can do pretty well in terms of, you know, consumption, dividends, and the market returns. But when you look at the risk-free rate, you're basically dead in the water. You look at the time series pass of the risk-free rate and what comes out of the model, and there's just no way of bringing these two together. And so the typical solution, I guess, in the state space approaches then is to just introduce measurement error. And in your framework, it's sort of taking, I guess, what the ESG model literature has been doing for a while. You just, you know, embed it into the actually structure of the model, and you call it, you know, use it, try to interpret it as a structural shock. And I could sort of, you know, when I saw what you did, I thought it was really nice, because that kind of solves that measurement error problem that we had in our state space framework. One of the things that you, of course, strikes you when you do this kind of, you know, likelihood-based analysis is that there are pretty drastic changes in the level of volatility. You know, I wonder, you know, when you do the GMM estimation, you know, assuming, I think, that the various volatilities are constant over this long span of time from 29 to 2000 something. I mean that's got to introduce some distortions and maybe having at least some breaks in the volatilities that capture what's happening in the data.
So let me say I agree. I mean, there's two things that I don't view what we're, the latest versions of Banzal-Kikuyaron emphasize conditional heteroscedasticity essentially in the tree, and it's quite important. There's nothing in our analysis that says that's incompatible with that. So we just thought, for now, doing the simple thing, where you can really see what's going on with the lambda stuff is important. But it's perfectly reasonable to say, what if you start breaking up the sample? You guys went really long, but now I'd like you to break it and do subsamples. We're totally open to that. We're totally open. I think there clearly is, this goes back to your talk, there's enormous evidence of non-Gaussianity in asset returns, and we're not going to get a whole lot of that here, obviously, right? So I think once you start getting really serious about details about the asset prices, you're going to have to go to conditional heteroscedasticity and other forms, and non-Gaussianity. So I agree.
Oh, back there.
That's just a little bit of a joke. But there is a note saying in Minnesota, I remember, it was nice that the RBC model wouldn't explain 100% of the volatility in output because the model was too simple. Do you want to explain 100% of these facts in a model with zero supply of bonds?
So let's talk about that. Well, first, I was part of that debate. I remember Rao Ayagari was my classmate, and he first made that argument. And I said, Rao, so what you're telling me is I should apologize for fitting the data. So I thought we did fine on that. We really don't want distance from the data to be a measure of success. Now, that said, which is basically, right, again, the point estimate is not literally the 7.5. So I'm taking standard sampling uncertainty very seriously. But if you want to focus on point estimate, we have plenty of room for those other things. But, I never found the argument very compelling. But if I could every damn statistic, I would. I can't.
Okay, so I have one question. The first issue is, you just said that, so I don't have to convince anyone. Log normality doesn't hold. So that means if you use the usual formulas for computing expectations, you have a bias using them. So I see that as a problem. And second, I understand you're trying to, or it's a parallel work to Mansell and Aron, but both papers have in common the idea that you need persistence to match the data. You have persistence in one state variable. He has persistence in consumption. So my question is, why is persistence necessary here, and why does it solve some of these puzzles?
Again, let me answer both the first question and then the second question. The first question on the log normality, we'll get on the computer and we'll test it out. Now, I'm going to probably enrage some people here. I've yet to encounter any first-order puzzle in macro that log normality was the culprit of. I have encountered many second and third-order problems that log normality might have contributed to. So, for my own taste in research, is first I want to understand the model as well as I can, check the approximations, and then go on. That's just a research agenda, how I want to proceed, from simple to more complicated. On the other thing is, look, we know the SDF has to be volatile, and the movements have to be persistent. That's sort of Hansen and Hansen-Jaganathan and Cochrane and all those guys. The question is, what is a plausible source of movement in that SDF? In our case, it's basically the risk-free rate. In their case, it's consumption, which I don't think we see. Now, we could say it's within sampling uncertainty, and there's lots of interesting ways to see that, but I think it's very nice that it's just the risk-free rate. Movements in the risk-free rate are persistent. So that's my answer, that it's an empirically plausible, measurable way to think about why that SDF is, there are persistent movements in it.
Well, I guess that's it for today. So thank you, everybody. So let's rest a little bit and get ready for tomorrow.